venture isn't right for every business. Do you have that right growth trajectory? Do you have that right margin profile to really utilize and make taking venture worth your while and your company and your employees as well as the investors' time? We're serious and we joke about it at the same time. It's fail quick, fail quietly, fail small, and move on. Right. And then just keep that iteration. Now, some of it's more difficult to do, but at the same time, all of the great ones we're working with now, they figured out this way to iterate low cost in the lab with limited resources, but they've shortened that feedback cycle. What started out as like a 90-day, they're getting down to like 7 or 8 days. So they can quickly iterate and move on. Right. So that's the key for a lot of these deep tech companies.
All right, Vic, welcome to Tech Scenes Unplugged.
Good to be here. Good to be back.
Yeah, good to be back, right?
Yeah, for sure. It's been a while.
Yeah, how many years has it been since we did Tech Scenes?
Was that
walked around
2017, 2018?
Something like that.
Yeah.
It's been a while. So for the people that don't know, let's start from the top. Why don't you tell me about Energy Capital Ventures?
Sure. Energy Capital Ventures is the only early stage venture capital fund that's solely dedicated to the sustainability, resilience, and digital transformation of the natural gas industry. In addition to that unique thesis, makes us advocates in innovation for what we've termed as green molecules. We further differentiate ourselves with customized engagement and deep integration with our corporate limited partners, all of whom are publicly traded energy companies. So it's this model where we take the best of the innovation of the startup ecosystem, combine it with the scale of the energy industry to make some great game-changing generational companies.
And how different is this than investing in tech that you had been doing for years?
It's different, but a lot of the same thing as well, right? So when I was doing a lot in financial services, compared to where I'm now in deep tech and energy, if you take a step back and look at the industries, right? Financial services, you had regulatory burden, aging infrastructure, people questioning their business models, new technologies that were going to enable or disrupt, conservative business practices, risk-averse cultures. It's the same thing that the energy industry is dealing with right here, right now. So it was great to kind of see those macro level trends and realize these are just great people in a great industry that want to innovate. They want to get ahead. They just need partnerships and partners like us to help them get there. So it was great to work with a new industry, new group of folks and take from there. But going from fintech to deep tech, yeah, it's a little different.
It's a little different. Green molecule. What is that? Like, I hear that. We've talked about it.
It is all the innovation that's relevant to that natural gas value chain. So think of all the decarbonization elements that aren't involved with the grid. So you've got things around within molecules on the molecule base, not the electron base. On the molecule side, you've got hydrogen, renewable natural gas, carbon capture, utilization, sequestration, methane leak detection, methane reduction and management. Then software as well that bring efficiencies and automation to the industry as well, or that broader value chain around the natural gas industry. And that's the part of it. So some funds, there's a lot of funds that are out there doing electrification, which is great. We think it's part of that equation, but it's not the full story. And that's what we focused on, what we saw as a great underserved market here in the green molecule side. And the great thing is after doing it for a couple of years, there's more and more funds now we're seeing follow suit. And either dedicating a portion of their existing fund to the molecule side, or even some of the broad generalists that aren't in climate or aren't in energy that are coming into what we consider to be our space. So it's exciting to see it grow over these years. Because back, 4 or 5 years ago, we started this thing. People are like, molecules, like, I don't know, is it really there? Where's that industry going? And we saw unbelievable opportunity and a great way to make some unbelievable companies.
Yeah. And what are some of those companies that you guys are looking at or investing in?
So Fund One, we have 9 portfolio companies in Fund One. So you've talked to plenty of VCs, and people are like, "Well, we're conviction based." Well, we're really conviction based because we got 9 companies across $60 million, right?
Right.
True conviction, hard concentration. These are companies that we really think are the true game changers of tomorrow. So we've invested in some Vita Factory, which is a synthetic biology company that takes basic waste sugars and creates biofuels. We've invested in Actual that does enterprise sustainability transformation software, but from a capital planning CFO seat. We've done Highwood Emissions, which is methane measurement and reconciliation. We've built Gold Hydrogen, which is in-ground, again, using synthetic biology to create hydrogen. C0, that's using pyrolysis to create hydrogen and graphitic carbon. We've done a turbo expander company, Sapphire Technologies, that takes pressure drops within the natural gas streams and converts that into energy by utilizing turbo expanding technologies that take pressure and create energy. We've also done osmosis, which is a membrane technology that separates out molecules and does the same thing around RNG, hydrogen, and other molecules as well. And Invertus Energy, which is a renewable natural gas company. They're in Austria, and they are bringing optimization to anaerobic digesters to increase yield within natural gas, renewable natural gas production devices by 40%.
Yeah.
And so it's really exciting stuff.
Yeah, that's interesting. How different are these companies like in structure than in the past in investing like fintech, and you invested in a lot of Coinbase, TrueCar. I mean, you had a lot of mostly software tech, right?
Yeah.
And,
I did a lot of marketplace, a lot of software, things like ID.me, Coinbase, Personal Capital, Prosper, Care.com. This keeps going.
Are these companies more R&D based in the beginning? And then once they kind of nail that product versus like iterating on like software or a marketplace?
We are coming in C plus Series A, and within deep tech, you are still well pre-revenue at that point, or meaningful revenues. And so we are, a lot of it just kind of like coming in at TRL, technology readiness level, around 4 or 5. The kids are going to get 9 when they're really in market. So we're coming in early, and because of that, these companies require different capital plans, different structures. A lot of it has to do with holding companies and project finance at the individual project levels, and so it's a different capital strategy that help these companies get to market. A lot of our companies have been fortunate enough to get some huge grants from the Department of Energy, and one of the companies I neglected to make mention in the 9 is Furno. They're doing a carbon negative and carbon neutral cement. They just were announced a $20 million grant from the DOE. So it's nice when we bring equity capital that non-dilutive grant government capital comes along with it.
Right. That's awesome. And then your investors, you said they're industry.
Yeah,
investors.
Right now. The first fund, the overwhelming majority, 99.9% of the capital, came from natural gas utility companies. Okay. So the local distribution companies, people that bring natural gas either into your home, multifamily units, commercial or industrial facilities. That was Fund 1. For Fund 2, we have a lot of those same investors coming back to Fund 2, but then we're also expanding that into the value chain a little bit deeper, into some of the midstream companies and some of the industrial partners as well that do a lot of the servicing within the industry as well. And then we've gotten some inbound interest from some traditional allocators that really like the uniqueness of our thesis and how the Fund 1 is maturing. And so maybe we'll see some traditional allocators, the family offices, those types of things. But we'll see. We would like working with large corporations. We like providing strategic value and benefits back to them, helping them understand the market, and they're great partners to us.
Yeah. Why did people not get into this space? Like, how did you guys end up being the first ones? Like, what was preventing that from happening?
At the very beginning, everybody was focused on electrification. Like, there was only one way to decarbonize, and that was force everyone to electrify. The reality is, when you force one type of energy, you end up doing more damage than good, right? And you find things that are horribly overexpensive, and you end up completely disintermediating whole communities that can't afford these types of energy sources, and their energy prices go through the roof. And so we thought there needed to be a fund just focused on this to bring balance to what's going on in the sector. And it was completely counter-cyclical at the time. It was the antithesis everyone had. And so now things have changed. There are other funds out there that work with large corporations. This model itself, actually, my good friend and partner in this fund, Rick Fatone, he had a similar model that he did with insurance companies back in the day. So him and his partner and one of our strategic advisors, Andy Levitt, they raised money from insurance companies and kind of did the same model with strategic value and advice on innovation back to the companies while investing in things that are relevant to the industry. So kind of a well-proven model, just not one that was applied to natural gas or what we more broadly defined as green molecules.
Backing up, for people who didn't know this, like you started out in the legal world. So
Right.
this shift that you've done, this is probably not as big of a shift compared to going from legal to, I believe you're an in-house lawyer at a growth tech firm, and then you went from there to investing, right?
Yeah, it's weird. I mean, I even started at the furthest extreme back in the beginning. Before that, I started as a trial lawyer, even before I became a transactional lawyer. So I had to go from trial work and fighting and screaming, yelling, and destroying people's cases and credibility to actually building something and helping people build their businesses from there. So that was a huge transition. The only way to do it was just to do it on my own. I had to start my own law firm focused on technology companies. And that got me in-house counsel for some software companies and raising capital and working with venture capitalists, managing cap tables, to then managing the IT transactions for a Fortune 100 company, Fortune 100 financial services company, and starting their venture practice in their firm.
What drew you into that?
I think initially what excited me about venture and technology was kind of what I hinted at before. It was always about building and making things and growing things and making companies that really change the world. But as a lawyer, I didn't feel like I was doing that. Definitely not as a trial lawyer. And that's what really drew to me first. And then from there, I got drawn to financial services because I thought at the time, the most important things for communities everywhere were financial security. If families and communities were not financially sound, everything kind of unraveled from that. What I realized was even more primary to that once I started looking at this space was energy. If you are energy poor or energy insecure, you literally have nothing at all, right? You can't power anything. You can't power your business. You can't heat your home. If you don't have energy to build an economy, you don't have anything. Like what we saw with the government, they could print more money, make more money, yet it's really hard to create energy if you've cut off energy sources and you've not innovated in the future of energy. And so that's why we look at things now. So what really drew this to me now was it was clean, safe, reliable, cost-effective energy. It's one of the mantras we have there. In making sure that we're always advocating for green molecules because we think it's broadly applicable to not just one section of the country or one section of the economic classes. It's global. It's for everybody, and it's playing an important role.
Yeah. Where do you see this industry going? Do you have like some ideas of kind of the direction it's going to take?
Yeah, I mean, I think it's going to what we've seen in the 4 or 5 years we've been doing this is the trajectory for green molecules is just at that starting to be at that inflection point where hydrogen, both as a energy source, and then even as an energy source for transportation, as an energy source for light industrial, commercial, or heavy industrial, is really starting to take off. Like we were just talking about sustainable aviation fuel 4 years ago, right? And now we have portfolio companies manufacturing it almost at full scale, right? When we thought about RNG as a clean fuel source for both residential and commercial, like it was just a concept. It's really scaling. So I think what we'd like to see And what we're seeing is the innovations just keeps going and going. What we want to do is bring more capital to the sector to really get more of these companies funded and had some great outcomes, both for our investing partners, but as well as for the broader world.
Yeah. I'll switch gears a little bit. Like,
Sure.
you've been investing for a really long time. Like, what are the things for you just makes it an easy investment? Like, what are you looking for in a founder, in the team, in the product?
For us, it's team, technology, competitive advantage, hopefully unfair competitive advantage, market, and then fit with our firm. The most important thing that unlocks all that is the team. So I have to see a team, which you saw with all the great companies I was been fortunate enough to work for that went from obscurity to publicly traded and household names. Those founders believed in not their company, they believed in the aspect of what they were building more than anything else in the world. So no matter what, they were going to make sure this company succeeded because that company was doing something really important for the world, right? Coinbase, I want to create a whole new financial system for people, right? Personal capital, they wanted to empower people to manage their own wealth at a lower fee. So it was democratizing access to financial planning and financial planning and wealth. All those companies, it was about something bigger than themselves, bigger than their company, bigger than return. It was doing something great. And so I got to see that in my firm. We all have to see that in the founders we're at today, because if we thought software was hard, right? What we're doing now with creating new energy sources in deep tech is really hard. So unless those founders that we're backing had that same connection to what they're doing and that same belief into what they're doing is more important for the world than anything else, that's going to take them through those ups and downs and back and forth that are just inherent in technology companies and building companies. We just know it's not going to go anywhere. So we really want to see that drive and ambition that's really about making the world a better place because they're technologies.
Yeah, that's awesome. That makes a lot of sense to me. What do you think? And I know I'm drilling you deeper because last time we talked about a lot of this stuff last time, so you can check out the older episode. But just getting a little bit, you've had so much interaction with founders and teams. Like, what do you commonly see kind of in the early stages that often where the founder gets in the way of themselves? Like, when you may have the great idea, may have the team or whatever, they have all these elements, but what are some of the things where you think founders get tripped up and maybe it's themselves that are getting in the way?
Yeah, I think all the great founders that we've backed to date at ECB Energy Capital Ventures, what we saw is they've all realized the right time to bring in that business partner or commercial partner, person from the industry that balances their technical acumen. So no different than in the days of fintech that were a little too heavy on the tech and not hard enough on the fin, right? And that led to a lot of bad companies and loss of money. What we're seeing here is these brilliant scientists that are coming out of the lab. They're finding that partner in the industry that's going to believe in what they're doing the same way they do, but brings, like I said, that business acumen to the table, that commercial skill set to help them understand what does it really take to go from where they're at in the lab or where they're at in the demo scale to the actual full scale. So I think it's critical that these founders can find their right partners, but then can also communicate that same sense of purpose, that same sense of passion that inspires other people to come and want to work with them to solve what we're viewing as some of the hardest problems in the world to solve. So that's really the key part to it, or where I see people have trouble. And that's why when we invest, we make sure that team is really solidified and they have those aspects and everyone's got those kind of counter balancing, complementary experience and skill sets.
Yeah, that you see that a lot in the software side of things too. A lot of times, the early stage founder, that's a technical founder that builds the product, and then they start to bring their team together, and they need those people that can come in and sell the product, lead the team, build the team. Sometimes, definitely takes a community to get something like that to work. It can't be one person.
No doubt.
And I'd guess where you're working on now is definitely really deep tech, really deep science. And, those people are typically not going to business school or probably didn't have those kind of business oriented jobs, I'd guess.
Yeah, a lot of them are PhDs or double PhDs, or they're physicists, or both. And what we're in software, an MVP was like getting code, getting into users' hands. Now, for some of our folks, like their MVP or their demo unit, it's 5 stories tall, right? Costing tens of millions of dollars to get going, and it's like a quarter city block that's changing the skyline for some of the cities where they're building these things.
Right.
So it's really another level of scale that comes with this business. It comes with deep tech and the stuff we're doing at Green Molecules.
Is it bigger risk investing in these types of companies?
The science risk is definitely that. Engineering, the technology risk is definitely deeper here, greater here, because you've got to, one, prove that the science, quote unquote, works, and then the science can scale, and then engineering feats that really take it to the full scale, global scale on things.
Right.
So there's risk, and it's like everything else in venture. You de-risk it by as much due diligence as you can, both on the team as well as that technology and the market. I gotta stop beating on the table. The team and the technology that's there. Whether it's our own homework that we're doing, coupled with that we lean on our investors. Plus, we've got a contingency of 25 strategic advisors, all of whom have deep backgrounds across all the engineering and scientific fields. We lean on those. And then every now and then we'll even bring in a third party that's there. But having done this for so long now, we feel pretty connected with our network to really ferret out and do the deep due diligence on seeing, okay, if this technology is going to fail or not scale, why and when, and what can we do to really de-risk that along the way?
Right. And, with higher risk is higher return. And if you can de-risk it by selecting the right and companies, that's where you win.
Right.
And yeah, it's an interesting focus and model. I think it makes a lot of sense.
Yeah. I mean, if you think our very first portfolio company, Cemvita, if they really crack the code and are cracking that code on sustainable aviation fuel, it could be one of the biggest companies in the world with the greatest impact on emissions that's out there. Similar, you see that with RNG and Furnace and Furno and cement and gold hydrogen, GH2, what they're doing with hydrogen, C0 is what they're doing with hydrogen as well. But pyrolysis, like these will be the Oxys and the Exxons and the BASFs and the Dows and Honeywells of tomorrow. So that's why it's really excited to be in space.
Yeah. And I would guess that if these people can't get funding for what they're working on, it's just not going to happen. So where were some of these companies getting funding prior to, firms like yours coming about?
Yeah, I think it was much harder for them at the earlier stage when we were at, because there wasn't a lot of people taking this early stage risk, or what we would consider to be almost the hardest check to write in venture, right?
Right.
When they're trending towards demo scale or trending towards pilot scale, but it's clearly not there yet. So a lot of them were relying on government grants, absent equity, which were good and bad depending on the grant that were there. Because a lot of these companies that we had seen in the past, they chased those grants, which pretty much it was a strategy drift, right? They wanted to do hydrogen a certain way, and this is what they're going to do. But a grant came out that was like a little bit more over here, right? And so you had that drift. So we think we can help with our capital. We're helping them maintain their focus and really go after what they are supposed to. Now, the good news is we've seen more and more a lot of later stage funds come into space. That like once that technology is coming to scale, they're more than happy to do the project finance, or they're more than happy to do the growth stage. But it's really at the earlier stages that there's still plenty of opportunity.
Yeah, I've worked with a lot of teams that relied on government grants, and they wanted to build a product, but they're getting their grants and getting this funding that tells them you have to build this, even though they're trying to build this, and then trying to create a strategy that allows them to leverage that grant to build the product. And it's very hard to do. It's very hard to do. And oftentimes they end up building 2 different products, and they feel like 2 different companies. And not only is the CEO confused, but the employees are confused of what are we really building? And if we are building just for this one use, is it going to apply across the space?
I mean, we see it time and time again, luckily, the things we haven't invested in, where everyone thought they could bring it together at the end, or they can make some step function or do it kind of a linear sequence. Like, oh, okay, we'll do this project with the government doing hydrogen this way. And then when it comes to the commercial market, we'll do this. Well, one, it's really hard to pivot these technologies like that. And then two, like you said, the employees are like, wait, which team is doing what? And like, which is the important team in the company? And then you create dissension amongst the teams, which is almost a death knell for a startup.
What's venture look like? You think the market right now? What's changed over the last few years, and what's the state of the market?
I mean, I think the way we've described it to our investors and the way we're looking at it, it's been the great return to the norm. Like people are like, oh, this violent correction is coming. Not really. If you look at it, we're headed right back to where we were before things went crazy in like 2020, right? You know, if you look at kind of that 5-year median from like 2012 to 2017, like we're getting back to that healthier stage. And, you know, with returning to the norm, there comes corrections. But like I said, we call return to the norm not necessarily a correction. And it's making capital more difficult for startups to come by. It's making it even more difficult for GPs like myself to raise because there isn't as many people investing in the class. Like a lot of people have this false presumption of, oh, it's venture and like, look at the returns. And I know all I've ever done is real estate, but let me plow into venture. Well, that didn't work out for a lot of folks. Right. Or for the firms that were public market investors or growth stage investors that try to come here. And that all that capital in the system really did some damage. And so, you know, there'll be some corrections that are going to happen as part of this return to the norm. But I think we're going to head back to a healthier environment where companies are raising, you know, 12, 18, or hopefully 18 to 24 months of capital. They're hitting their metrics. They're not asking for unreasonable valuations. They know about what the market norm is that they're going to give up at each stage. And they're going to look at, here's the money I'm raising, here's what I'm going to accomplish, and here's what I think I'm going to be worth once I come out of that based on this performance. And so it's really not a deal game or a valuation game. It's really about what are you going to accomplish? What are you going to do over what period of time?
Yeah.
So we love that pragmatic return to the norm, we call it.
Yeah. Well, I think, you know, there's always companies and people that feel like in venture world, people are just wasting and spending a whole bunch of money. But the real good venture-backed companies are super capital efficient.
Right.
You know,
Absolutely.
They may be going really fast and spending a lot of money in certain areas, but the best ones, I believe, are the ones that are organized and they're making very strategic bets within the organization where they're putting that capital.
The way we look at it is like, who are the companies that are investing into growth? Not burning capital just to grow unreasonably or would not, but like when they see it, when they've tested their way into it and the right signs are there, when are they stepping on the gas to then invest into that growth versus burning capital and being capital inefficient? So that's where the market is heading. I'm not going to say we're not 100% there yet, but it's getting there. We're getting back to that.
I like how you said tested their way into it, because I really see that as venture and venture companies are always testing and seeing what works and testing this, testing that. And once they can make 1 + 1 = 3, 4, 5, then they throw a little bit more capital, more resources to that and see if they can 1 + 1 could be 12 or 15. And I think the whole organization's laid out like that. It's really like dialing in and testing things until they figure it out. And that's the time when you go get capital. And you don't always have to go get capital. That's the other thing I think people get confused about. If there's nobody in your space and there's no rush, and there's no, to like a finish line, I don't think you have to go get capital. But then there's some of the stuff that you're working on where you need the capital to do the R&D to figure it out. So that can be different too.
I mean, venture isn't right for every business. We talked about this a lot. Like, it's not the right enabler for a lot of businesses, right? So do you have that right growth trajectory? Do you have that right margin profile to really utilize and make taking venture worth your while and your company and your employees as well as the investors' time? So it's definitely not right for everybody. But we like to see companies, we're serious and we joke about it at the same time. It's fail quick, fail quietly, fail small, and move on, right?
Right.
And then just keep that iteration. Now, some of it's more difficult to do with the deep tech companies, but at the same time, if all of the great ones we're working with now, they figured out this way to iterate low cost in the lab with limited resources, but they've shortened that feedback cycle. Like, so they know really quickly. What started out as like a 90-day feedback loop to see if something's working, they're getting down to like 7 or 8 days. So they can quickly iterate and move on.
Right.
So that's the key for a lot of these deep tech companies.
The companies that can iterate and change quickly are the teams that always win. And if they can keep an alignment together while they're doing that, they're going to succeed.
Absolutely.
On the capital side, I have a client, one of our teams, where the founder just really had a hard time raising capital over and over again for a couple of years, just trying so hard to raise capital and wasn't able to raise capital. But all along, she was building value in the company. And she got the company over 8 million ARR without raising capital.
Jeez.
And then when she did go finally raise that round, she was able to hold so much equity in this company and already tested and figured out all the dials she needed to move, and really built a big company really quickly once she had that all dialed in. But it was a blessing in disguise that she couldn't raise the capital, right?
Yeah, I agree, definitely. I mean, you get to the point where you've built your business, you know what works, you know what doesn't work. 8 million ARR, it's fantastic. But then you get to be a price giver, not a price taker, right? Because you've built something of enormous value. You know what it takes to get to the next level from there. You've got a working business. And then it's just a matter of rinse and repeat. And that's where you get to be like I said, the price taker, not the price giver. Or price giver, not the price taker.
All right. I have one last question for you because I've been hitting you with a bunch of questions. But I only have one last question, and I'm really curious what you're going to answer on this one. So it's a scenario.
Okay.
So you are trapped on a desert island the rest of your life. You have food and water and shelter, healthcare, everything you need. The one thing you don't have is entertainment. You have no entertainment at all. But an 80s boombox drifts ashore, and you get to choose one album to listen to the rest of your life. Just one album the rest of your life. And it can be any genre, any era, even though it's 80s boombox. But you only get one album. What album are you going to bring?
I have such different musical choices based on what mood I'm in, from hardcore rap to singer-songwriter to metal. And so what would be the one
I knew I was
album
going to get you.
just stacked? That is really hard. DMX's Blood of My Blood, that was stacked from track 1 to track 11. Like, you could just, that and DOC. I'm definitely going to stick in my rap genre. DOC's The Formula was actually pretty incredible straight through. And I'm going to go with DOC The Formula because he brought metal into it. He did old school rap. He did gangster rap. He was one of the first people to do it. And that album was stacked. So yeah, I'd probably keep that.
All right. Awesome. There's a lot of variety in that too. So you don't have one thing. It's a great answer. All right. Cool. It was great talking with you. Thanks for joining me on the show.
Great seeing you.
Yeah.
Looking forward to seeing you in person one of these days.
It will happen again, hopefully soon.
All right. Sounds good.